What I'm going to talk about today, Chris and team, is something that I learned early in my investment career that completely changed the trajectory of my investment life and how I thought about investments and how I thought about investing in real estate. This was a concept that prior to knowing it, and I should probably take a few steps back, I started buying investment properties in the year 2000. My mother and I started a family office, and today we've scaled that to 176 commercial tenants, and we now own a nine-figure portfolio, and we still manage that portfolio of commercial properties. We started with residential properties, and when I learned this concept, I realized I had to go faster. I had this huge advantage that other people didn't understand. And I was able to see 10, 20, 30 years down the road. And it put me on a trajectory to fast forwarding my real estate investments from what I learned. And I get to teach you that today. And then, as Chris mentioned, we're going to then, in the second part of the presentation, get into creative financing opportunities for self-employed folks who are working with great tax advisors like TaxHive, who help you get your legal taxable income as low as possible. But that can often create qualification problems when you go through the conventional underwriting channels. So we're going to teach you first the most important real estate lesson that I ever learned as an investor, and then I'll get into how to creatively structure financing so you don't have to use tax returns to scale your real estate portfolio. All right, let me share my screen here. And this is the first time in the TaxHive office, so in this studio. So hopefully everything goes smoothly there. Let me just get to presenter mode. All right, I think we are in good shape. Chris, it looks like you can see my screen, so I think we're good to go.
Looking great, yep.
All right, thank you very much. So this presentation is called the Real Estate Investor Financing 101, which is going to be the second part of this presentation. And then the first part is going to be how inflation makes intelligent investors rich. So to explain that to you, I'm going to take you on a little bit of like a monetary journey to teach you a little bit about where inflation comes from and how it is pervasive in our fiat money system. So I'll walk you through, and we'll start with a quote from Adam Smith. Adam Smith said, "The problem with fiat money is that it rewards the minority that can handle money, but fools the generation that has worked and saved money." What he's saying there is there's a select few who understand how money works and learns how to make it work for them, while the majority of people are robbed by inflation. And we're going to show you in this presentation how to actually turn inflation into an asset or turn inflation into a tailwind for your real estate investments. First of all, let's just define for everybody, what is fiat money? Fiat money is a government issued currency that is not backed by a physical commodity, such as gold or silver, but rather by the government that issued it. The full faith and credit of the US government is what our dollars say on them. And that hasn't worked out so well for us, especially over the last decade. So we became where we entered into this fiat money journey in 1971 when President Nixon announced before the nation, "I've directed the Secretary Connolly to suspend temporary convertibility of the dollar into gold and other reserve assets." So what that means was, prior to this announcement in 1971, you could literally take your dollars into a Federal Reserve Bank and they would give you gold. You could trade it for gold coins or gold bars. It was convertible or backed by the value of gold. And the benefit of having an economy that is a money that is backed by a commodity is there's a limit in how much money you can print. All of a sudden, in 1971, when the US dollar wasn't backed by gold, the US government and the Federal Reserve could print as much money as possible. And of course, that is where inflation comes into the system. So let's just go back to 1971 for a second. In 1971, you could buy a brand new house for $25,200. The average annual income was $10,600 a year. A new car was $3,500, and you could send your kids to Harvard University for $2,600 per year. Wow. Things have certainly gone a long ways from 1971, for sure. In 1971, a $1,000 bill bought 25 ounces of gold. 25 ounces of gold. Today, it buys 0.25 ounces of gold. And as this Twitter post here says, or X post, gold isn't exploding, fiat is imploding, meaning that it's not that gold is becoming more valuable, it's that the dollar is becoming less and less and less valuable over time. So this is a really interesting slide, and I'm going to take this one slow because I definitely want everybody to understand the slide, and hopefully you can see my mouse over here. I'm going to start on the green line, and this is U.S. home prices valued in dollars. So if we go back to 1953, the median home price in the United States was about $18,000, believe it or not. These are the stories we heard from our parents and grandparents. And as you move to the right, all the way on the very right-hand axis, you see that the median home price was about let's call it $425,000. So the price of homes went up significantly from 1953 to 2025. Now, let's go to the blue line. This is the price of gold. And the price of gold in 1953 was $35 an ounce. And if we fast forward all the way over here, well, this is before gold hit its epic run in 2025. This only shows gold value at 2.3K. We all know it's above 4,000 today, so it's nearly doubled again from then. But the price of gold measured in US dollars also went up significantly. But what if we measure home prices not in dollars? What if we measure it in gold? This is really interesting. So the red line is home prices measured in gold. And what you'll see is, if you follow the home prices measured in gold, that today the price of a home measured in gold is less than it was in 1953. So what this shows you is, it's not that the value of homes have exploded. It's not that the value of gold has exploded. It's actually that the US dollar has been so devalued that everything feels expensive. But the problem isn't the expensive house or the expensive gold. The problem is the fiat money system, the amount of money printing in the economy, and the inflationary value devaluation of gold, I should say. I just find this chart particularly interesting to highlight the fact that based on today's dollars, based on today's gold price, home prices haven't moved that much. It's only in dollar terms that home prices have moved so much. So let's look at cumulative inflation going back to 1913 to kind of get a measure of how big of a problem is this inflationary problem. Going back to 1913, which is the year the Federal Reserve was created, and going forward all the way over to about 1970. So that would be a period of roughly 57 years. Over that time horizon, cumulative inflation was about 284%. So let's just say rough numbers, 300% inflation over roughly 60 years. That means that the prices are doubling about every 20 years. That's not really all that bad if you think about it. That means a 5-cent piece of gum costs 10 cents 20 years later. But in 1971, when we left the gold standard, you see this hockey stick up and to the right type of trajectory, which is inflation absolutely taking off and accelerating because of all of the money printing that's going on in the US economy. And that was enabled by the fact that we moved to a fiat currency. No longer was the US government constrained by increasing the money supply because it had to be backed by gold, so you could just print into oblivion. of course, with the full faith and credit of the US government. Now, this is obviously a huge problem because if you're saving in today's dollars and you're hoping to fund your retirement in future dollars 10, 20, 30 years down the road, the problem is the future buying power is going to be a lot less than today's buying power. So we're saving today, hoping to get to a dollar amount of savings that'll sustain us through retirement, but we don't know what we're going to need in retirement because this inflation has gotten out of hand. All right. I just got a question in the chat. I'll just address this real quick. A bit off topic, but may I ask, if I go down south and see an investment property before April 15th, can I deduct the trip as a business on my 2025 tax returns? We would need a tax specialist to answer that. But my opinion, and I'm not a tax expert, is no. You would need to have incurred those expenses in 2025 to write them off in your 2025 tax returns. But you should check with your tax hive tax advisor to see if they have any type of a different opinion.
You nailed it,
Josh, you are correct.
You nailed it.
Okay. All right. Woo. I'm 1 for 1. Thanks, guys. Appreciate that. So what's the end result of all this inflation? Well, this was a survey that was done by the Wall Street Journal, and it says people like me have a good chance of improving our standard of living. And you can see if you go back here to the 1980s, 75% of people agree with this statement. People like me have a good chance of improving our standard of living. We have a positive outlook on life and our future. Well, if you forward that to today, over here in 2025, only 25% of people today believe that they have a good chance of improving our standard of living. Well, why is that? It's because we're earning in today's dollars, saving for tomorrow, and when we go to use that money to buy a house or to make a business investment or to fund our retirement, what we thought we were going to be able to purchase, we can't purchase because everything costs so much more. So, this is the terrible effect of inflation. It not only erodes our finances, but it erodes our culture. And it erodes the confidence in this entire money system that we have. Now, that's the bad news. The good news is I learned a lesson from a gentleman early in my real estate career, teaching me how to use inflation as a tailwind, how to use inflation to supercharge your investment trajectory. And there's a lot of numbers on this sheet, so I'm going to go slow, and I have several slides to illustrate this point. I hope that you'll end up on the other side of this lesson in the same place that I was when I learned this, that there's such a tremendous tailwind behind me, I have to accelerate my real estate and journey. I learned this from a gentleman by the name of Jason Hartman. He licensed me to teach this information as long as I gave him credit. And you can learn more from Jason at his website, which I put up here, jasonhartman.com. He's an absolutely gifted teacher and real estate coach. So this was a case study, and as I recall the lesson being taught from him, this was an actual case study of his mother buying a home in 1972. And he ran the numbers through the 30 years that she had this mortgage. And it illustrates the point that inflation destroys debt over time. So let's start over here on the left. The value of the home in 1972 was $18,000. The mortgage amount was $14,000. So she put down approximately 20%. The mortgage interest rate was 7.37%. They did a 30-year loan. Her monthly payments were $100 a month, and she was at a 33% tax rate because that plays into this equation that I'm going to teach you here today. This is the chart of her mortgage payments, like an amortization chart, if you will, over that 30-year period of time. So we can see in 1972, she started making payments, and in 2001, she paid off the mortgage. Next to each of those years, he charted the annual inflation rate for every year. So in 1972, the inflation rate was 3.2%. In 1974, the inflation rate was 11%, et cetera, all the way through the 30-year amortization of the loan. And then Jason charted the devaluation of the dollar. You see, if inflation was 3.2% in 1972, that means the buying power of that dollar, or the value of that dollar, was less in 1973. And you can see just within the first decade, between 1972 and 1981, the value of the dollar had been depreciated from $1 down to just 46 cents. And he did that same exercise, charted the inflation, then the value of the dollar over a 30-year trajectory. Then he charted the nominal payments. Now, this is a very important term. Let me define this. There's nominal and then there's real. Nominal is the number of dollars that you write out of your checking account. In this case, these are the dollar amount that she paid out of her checking account each year to make her mortgage payment. Those are the actual number of dollars that left. Real is inflation adjusted, because the value of those dollars year after year is worth less and less and less and less. So you'll hear in economics speak, well, is that a nominal return? Meaning I made a 10% return, but if inflation was 5%, my real return was really only 5%, because the buying power of my dollar lost half of the return. So this column charts the annual nominal payments that she made. In this column, it charts the annual inflation adjusted payments, because we see that the dollar was devalued by inflation each year. So the inflation adjusted or real payments decreased year over year throughout the 30 years. And then in the final column, there's an additional adjustment for annual after-tax inflation adjusted payments. So this is adjusted for both inflation and for taxes, for the actual or real payments after taxes over that period of time. Here's where it gets super interesting. In nominal terms, over 30 years, she repaid the bank $36,000. So just to anchor us back, she had a $14,000 mortgage. She had to pay the principal back over 30 years. Then she had to pay the interest back. So total payments over 30 years was $36,000. But in real terms, adjusted for the devaluation of the dollar due to inflation, her annual inflation adjusted payments over 30 years was only $16,000. So she had made $36,000 in payments, but it only felt like $16,000 in payments, because inflation over that period of time increased her income. And I'll show you a chart in a second to show you exactly what I mean. So she each month, you can see it felt like she was making a lower and lower and lower and lower payment because of inflation and the devaluation of the dollar. Then we come back to the final column with after-tax inflation adjusted payments. So after we normalize for the rate of inflation and we normalize for the tax benefit, the amount of money that she paid in interest on that loan, or total repayment of that loan, was only $12,000. So here's where most people say, well, what do you mean it felt like she was making lower and lower payments each month, Josh? I see that you've adjusted for inflation in this column, but why would it have only felt like she made a $285 a month or a year payment when the actual dollars that left her bank account were $1,200? Because when you have inflation, wages go up. So let's take a look at what this looks like from an income perspective, comparing the trajectory of income in America from 1972 to 2001 when she paid on the mortgage. So this is median personal income, not household income, personal income in the United States from 1972 to 2001. So in 1972, the median income in the United States was $4,640 per year, roughly $400 a month. By the time she paid off the mortgage in 2001, The median income was almost $2,000 a month. So the amount of income that she had to pay her mortgage every month went up, but her mortgage payment stayed the same. Here's another illustration. It would have felt like this. When she started making her annual payments at $1,200, it was a huge portion of her income. Think of it this way. If she was bringing in $400 a month in income and her mortgage payment was $100 a month, 25% of her income was going towards her mortgage. Fast forward to 2001, she's bringing in almost $2,000 a month. She's making a $100 a month mortgage payment, which means that she's only about 5% of her income is going towards her mortgage payment. So it feels over a long period of time that the debt is being eroded, or the amount of dollars is less substantial to the budget because income is going up over that period of time. Now, here's the summary. Let's go back and start from the beginning. The mortgage size was $14,614. The nominal dollars to repay the loan was $36,000. The interest rate was 7.37. The inflation adjusted dollars to repay was $16,000. So if you adjust the interest rate by the rate of inflation, she actually only paid 1% over that period of time. But after she adjusted for taxes and inflation, she paid $12,655 to pay back a $14,000 mortgage, which means her after-tax inflation adjusted rate of cost of that loan was negative 1.16%. This was the slide that changed everything for me. I thought, oh, wait a minute, let's apply this to investment properties. If my mortgage payment stays the same for 30 years, but the rent on my properties go up for 30 years, then it feels like, or a smaller percentage of the rental income goes to mortgage every year. This is a huge tailwind or advantage for real estate investors. And then, of course, we get to write off the interest as a tax deduction. Now, with the big, beautiful bill, of course, we get to do what's called bonus depreciation, which I can define a little later in the presentation if there's questions around that. But that's a way to pull forward the depreciation of a real estate investment property such that you can massively take tax deductions in the year that you acquire a real estate asset. You don't have to wait over 39 or 27 years, depending if it's commercial or residential real estate. So I can get to that in a few minutes. Let me give you another case study. This is a real life example. This is a 8-plex that my mother and I bought up on Capitol Hill in Salt Lake City, Utah, right next to the Capitol, overlooking the Great Salt Lake. Epic sunsets over the Great Salt Lake for anybody who's seen them. A beautiful property. We actually still own this property today. So purchased this property in 2001 for $315,000. The average rent in the building, remember we had 8 units here, the average rent was $800 a month. So that gives us $2,400 a month total, $300 a month times 8, $2,400 a month in rental income, times 12. We're bringing in $28,800 a year in rental income in year one. Now, we financed this property 100% financing from the seller. The lady and her husband who actually built this property originally back in the 70s, built the property. It was their retirement plan. When he died, she could no longer keep up with the property, but she wanted rent. She still wanted income. So she financed the whole $315,000 to us at 7%. Our monthly mortgage payment was $2,096. Now, some of you might be starting to see there's a problem here. If my rental income was $2,400 and my mortgage expense was $2,096, that means that roughly 90% of my income was going to cover my mortgage payment. So the annual debt service on this property, $25,000, annual income, a little less than $29,000. This created negative cash flow for the first 5 years. Welcome to real estate investing. You get in where you can and you find a foothold and you figure out how to make it work. But there's a happy ending to this story. If we fast forward this story to today, this is an actual rent roll from this building, and this is the rest of the units here, these pictures. The rents have grown from $300 a month to now we have rents that are in the $1,495, $1,500, $1,550, $1,570, $1,595, and we have other income because now we charge for storage and parking and those types of things. So now our monthly income is $12,650. But if you remember from the original scenario, my mortgage payment is $2,096. My income has grown to $12,650. So now less than 20% of my income is going to my mortgage payment. When I bought the property, 90% of my income was going towards the mortgage payment. So this is how inflation destroys debt. And I'll just take down the screen share here for just a second to make this point. Whether you're buying a primary residence or you're buying an investment property, if you can put 30-year debt on a property and year after year, either your income goes up because inflation pushes up wages, or if it's a rental property and inflation is increasing the amount of rents, over long periods of time, what you'll see is higher and higher income and your mortgage payment staying the same, which means the percentage of dollars that is leaving your checking account, whether that's a business checking account and you have rental income in it, or whether that's a personal checking account and you're depositing your income in your personal income into it, your income is going up while your mortgage payment stays the same, which means the percentage of your income going to service your mortgage goes down over long periods of time. All right, I'll go back to the screen share here and keep rolling. If anybody has any questions, I'm doing my best to watch the chat. If I miss anything, feel free to call me out, Chris. So this brings up a curious question, which is, who benefits from all this inflation? Well, if inflation destroys debt, the person with the most amount of debt or the entity with the most amount of debt would be the primary benefactor. They would win the most. And as it turns out, the United States government is the #1 debtor in the world by a very, very large margin. In fact, when this was printed, the US debt was at 38.3 trillion. In fact, let's just do this real quick. I'll just see if I can navigate to the US debt clock that I just had pulled up here. Okay, here it is. So now we've grown to the US national debt of $39 trillion. And the US government brings in about $5.4 trillion each year. But the problem is the US government spending is $7 trillion. So that leaves a US federal budget deficit of about $1.7 trillion. And unless you think the US government is going to stop spending at this pace, you can expect that inflation is going to continue. And that means that we have to figure out as investors, how do we protect our nest eggs? How do we make sure that the dollars we're working so hard to save today actually fund the type of retirement that we want when we're done working? And I've found that real estate and being able to use inflation to destroy debt is one of the best inflation-adjusted investment vehicles out there, especially now that we have the big, beautiful bill and all the advantages of the bonus depreciation that I alluded to earlier that we can get into here at the end. Okay, so now let's go back to the presentation and I'll go to the presenter mode. Okay, very good. So now, how do we finance real estate investments if you're interested in doing so without having taxable income, significant taxable income on our tax return? Well, the good news is there are loan programs out there that don't require tax returns at all. So I'll kind of run through these 4 different types of loan programs for everybody. And of course, I can take questions on these. Most of us are all familiar with conventional loans. This is your Fannie Mae, Freddie Mac, And then, of course, then there's VA loans and FHA loans. And all those types of loans generally require tax returns and W-2s. They're going to look at your adjusted gross income. They're going to calculate that, and that's what they're going to use to see your qualifications. They're going to require full tax package. If you're buying an investment property, they're going to require at least 15% down. You're stuck to the conforming loan limits, depends on where you are in the country, but roughly 700,000. And this is really best for W-2 employees. If you're a self-employed entrepreneur, there's a lot better programs for you to qualify to fuel your investment portfolio. The first one that I'll talk about is what's called the debt service coverage ratio. Debt service coverage ratio loan means you're using the rental income from the property that you own or the property that you're buying, and you're using that rental income as a qualifier to debt service the mortgage, to qualify as the income for the mortgage payment. It's based on leases or market rents. You can put as little as 15% down. You can do loan amounts up to $5 million, and this is great for rental property investors. Problem with this type of a loan is it doesn't work for second homes and vacation homes, and it doesn't work for primary residences because obviously there's no rental income to service the debt. So an alternative program for second homes and primary residences is a bank statement loan. Instead of turning in tax returns, you turn in 12 months of personal or business bank statements, no tax returns needed whatsoever, and we take the cumulative deposits of those bank statements over a 12-month period, and that's what we use to calculate your income. You can do as little as 10% down. You can do loan amounts up to $4 million, and these are great for self-employed or 1099 income. Also, somebody maybe who started a new business within the last couple of years. And then last but not least is the asset depletion loan. This loan, instead of using tax returns to prove income, we look at your net or liquid assets. So this could be retirement assets, brokerage accounts, bond investments, checking, savings, money market, anything that's liquid. We can take those assets, divide it by 60 months, and that's the income figure that we can use in lieu of using a W-2 or tax returns. This is great for self-employed investors who have exited. So if you've sold a business or you have some big lump sum of liquidity sitting around and you're trying to parlay that into real estate investments, we can use the liquid assets versus tax returns to qualify. I recently had a gentleman who owned 13 car washes. I believe he was out of Alabama or Georgia. I can't remember. And he'd sold the car wash business, paid out all of his employees, all of his partners, paid off all of his debts, paid all of his taxes, and he had $7 million left. He put the $7 million in a high yield savings account with a bank. And then about 6 months later, he went to the bank and he said, okay, now I want to start to build my real estate portfolio. And they said, well, show me your tax returns. Well, his tax returns showed that he just sold his business. And they said, sorry, we can't give you a $400,000 mortgage. He said, let me get this straight. I've got $7 million in cash sitting at your institution, and I can't get a $400,000 loan to buy an investment property? Sorry, your tax returns don't work. So for people like that who have exited or have a lot of liquidity, the asset depletion program is a path of least resistance and works really great. Also, we should let you know that there are lines of credit that are available on your existing properties. So if you own a primary residence, if you own a secondary home, also known as the vacation property, or an investment property, you can open up lines of credit against those properties. Let me just define line of credit, because that was a question that came downstairs today. So a line of credit means, let's say you have $200,000 in equity in a home, and you want access to 100,000 of it, but you don't necessarily need to use the whole 100,000 right now. You just want access to it. So a line of credit would give you an ability to draw up to $100,000. But if you only need 5,000, 25,000, 50,000 right now, you're only going to pay interest on the amount that you draw. This is very similar to a credit card. If you had a $10,000 limit on your credit card and you had a $100 balance, you're only paying interest on the $100 until you pay it back. The other nice thing about a line of credit is it doesn't disrupt your existing first mortgage. So if you have a very low rate first mortgage, say a 3 or a 4% rate, and you don't want to disturb that low cost of capital, the home equity line of credit goes behind the first mortgage. That's why they call it a second mortgage. And we leave the first mortgage alone, and you can still access the credit or you can still access the equity in that home without disturbing that first mortgage. We have the ability to do these loans with no tax returns. On primary residences, you can access up to 95% of the value of a home. So, if you had a $400,000 property that you owed $200,000 on, you could do a line of credit up to $380,000. So we take $380,000 as the limit minus the $200,000 first mortgage, means you could get a $180,000 line of credit on that property. And again, if you don't need the whole 180,000 or you don't need the money right now, you don't pay interest until you draw out the money. You can do loan amounts up to 750,000. You can use it for whatever you want, to grow your business, to invest in real estate. Maybe you just want a liquidity fund, a slush fund, because your business has normal cyclical or seasonal variations, and you want to use that line of credit to smooth out those variations. And these loans can be closed very quickly, in some instances as little as 2 weeks. Last but not least, bridge loans. Bridge loans enable you to buy a new property before you sell the property. So in many instances, we'll have for example, let me just give you an example. We had a gentleman in California who owned about a $2 million home in San Diego. It was an investment property. He'd inherited it from his parents. And he had $2 million of his net worth in one home. And he felt he wasn't very diversified. And those of you who own investment properties in California know it is a very high price to low rent ratio area, meaning he wasn't yielding as much in rents on a $2 million in equity as he would have expected. So he used this buy before you sell or bridge loan program, where we put a loan against his free and clear $2 million home in California. He then went out and bought 5 properties in the Sun Belt. So he bought in Alabama and Georgia and Tennessee and Texas and areas of Florida. And he went out and acquired 5 investment properties in those areas. Then he sold his San Diego home, paid off the loan completely, and was left with 5 free and clear properties in higher rent, lower price areas. This also works for owner occupants. If you own a home and you want to buy a new home and you find the new home before you find a buyer for your old home, you can use a bridge loan to acquire the new home with no money down using the equity in your current mortgage. Happy to answer questions on that. But the reason why investors tend to use bridge loans, you can close fast in many instances within just a couple of weeks. You don't have to wait for the property to sell. You can tap equity from your current holdings without selling. You can use the funds for acquisition, rehab, or stabilization. Stabilization is waiting until the property gets leased up. So even if you wanted to buy a new property and do a renovation component, that's possible. And many people will use this bridge loan program to buy and fix up an investment property. And then once the investment property is rented out, then instead of selling the initial home, they'll just refinance the debt once the investment property is stabilized. Please clarify your role. I've got a chat here. Hi, Paul. Nice to have you with us today. Please clarify your role as a lender or broker financial instruments. Your presentation is well done. Thank you. Thanks, Paul. I really appreciate that. So the answer is both. And let me explain the difference for anybody who doesn't know. A lender underwrites their own mortgage, approves the loan, and then funds the loan with their own money. A broker will take your mortgage application, send it to somebody else who's going to do the loan, and then they fund the loan. There's advantages to both, and we're in both channels. We're a direct lender, but sometimes there's such a competitive lending landscape out there that you can't possibly have every loan program under the sun, moon, and stars that you do as a lender. So oftentimes lenders are limited in the products that they have to offer. Many times people are only lenders on conventional loans, VA loans, FHA loans, but any of these non-traditional loans that I'm describing, they broker. And that's the situation for us. We are a direct lender on some of our products, and we're a broker on others. And I feel, as a real estate investor and someone who works with real estate investors all the time, that gives us the broadest amount of solutions to serve you. So great question. Thank you, Paul. Yeah. So, and then of course, yeah, I mentioned the flexibility to use funds for acquisition, rehab, or stabilization. And then of course, continuity, meaning you can buy the new property before selling the other. This is really like the ultimate headache remover. You can buy the new property, get settled, and then figure out what you're going to do with the other property, or if you want to refinance the new property. All right, so these are just a few real success stories from investors we've been able to help. This is Brian, real estate investor, saying that Neo understood what other banks couldn't. They looked at the property's income, not just my W-2s, closed in weeks. This is from Brandon, saying bank of blank declined me after months. We took that out. Neo used my deposits and we closed in 18 days. Brandon was in a particularly tough spot. He had done a new construction deposit of over $400,000, and after he'd been going through a construction project for over a year and had been pre-approved with this lender, once the home was done, they declined his financing after having pre-approved him, and we were able to save that and get him into his home in 18 days. And then Priya says, didn't touch my working capital. They structured my deal so my cash stayed in motion. That was super cool. We were able to help Priya get a line of credit on her existing property and then use that to scale the real estate investments. We got a question from Marco here. Thanks, Marco. My New York co-ops are tough for HELOC and cash outs now. Do you do co-op loans? Also, what loans on solo 401ks? Also, what about loans on solo 401ks? Is that a non-recourse loan? I have a W-2 and own a business. Okay, co-ops. That's a really good question. I know that we do first mortgages on co-ops, and the honest answer is I don't know if our home equity lines of credit programs work on co-ops or not. I will encourage you, if you would, Marco, please send me an email and let me do some research for you and make sure I give you a truthful answer. I want to be impeccable with my word, and I just need to do some research for you. So you can email me at josh@joshmettle.com. That's josh@joshmettle.com. And I'm sure here in a minute I can drop that into the chat. Actually, here we go. That would just be easier. josh@joshmettle.com. All right, great. That should be in the chat for everybody to see now. Please do email me. Okay, and then you said, also, what about loans on solo 401ks? Is that a non-recourse loan? Yes. Whether it's a solo 401k or a self-directed IRA, you can't do a loan against an asset that's owned in a 401k or a self-directed IRA if it's recourse. So you have to do non-recourse. We do have some access to some of those products. Happy to help you. Great. And you have a W-2 and own a business. You know, you're in a very typical situation for most of the people we help. We'd absolutely love to help you. Feel free to email me or schedule some time with us. I'll give you a link to schedule time with us here in a few minutes. You're welcome. Okay, on with the show. Let's see. Okay, great. So I've created for you a gift that I think might be helpful for you to understand this inflation-induced debt destruction idea. We've created a calculator that you can use so that you can analyze the debt on your primary residence or your second home or your investment property, and you can apply an inflation adjustment to it and see what your true cost of credit is, your real cost of credit adjusted for the rate of inflation. I've found that super helpful for me. I went through each of my real estate properties plugged in the interest rate that's on my mortgage statement and then calculated what my after inflation adjusted cost was. And I've created a calculator for you all to do that as well. If you follow this QR code, you'll be directed to a website that looks like this. And actually, let me just drop this link really quickly for everybody who couldn't get the QR code. I will put that link in the chat. All right. That should be there for everybody to see. But once you click that link, you will end up on a website that looks like this. Let me move my screen around. Get this out of the way. There we go. Let me just close this for a minute. Okay, great. So this is super simple. You just plug in your mortgage balance, your remaining term, how many years you have left in it, your monthly principal and interest. Do not include taxes and insurance, just your principal and interest. And then you click in the annual inflation rate. We've plugged in 3.9% here, but if you click on the source button, this will take you to the actual CPI inflation calculator. And this will show you from 1971 to 2026, the average inflation rate over that period of time was 3.87%. So we just adjusted for that and called it 3.9%. And then it'll give you and then your interest rate of your loan, calculate my real cost, and then that'll give you an after inflation adjusted real cost. I suggest everybody does that on their mortgage statement just so that you can really have mastery of this inflation induced debt destruction concept. And then if any of you would like to get with us for a strategy call and have any of your questions answered, maybe you just want, many clients will come to us and just say, hey, I have a portfolio of properties. I'm looking to build my investment portfolio. What do you see here as opportunities? And we'll go through and show you potential opportunities that you're not seeing to access liquidities or ways you can get financing that you may not be thinking about. And that's here on the same website that I dropped into the chat, or if you follow the QR code, you just click a link here and then click a time that is convenient for you. All right, well, with that, we've got about 9 minutes left. I'll just open it up to questions. Does anybody have any questions in the chat or Q&A or anything else I can do to help anybody who's here on the call today?
Hey, Josh, while somebody might be chiming in a question there, I just want to say thanks. I mean, every time I listen to you train, I'm just taken back by the insight that you have. And man, this is stuff I wish I understood 20 years ago. You know, I wish I understood all this 20 years ago, but there's no time like the present. So thanks. And I just want to give my ringing endorsement to anybody here. If you're in a spot where you're looking to get some money, some loans, acquiring properties, wholeheartedly here at Tax Hive, we endorse Josh, and no harm, no foul. Take this meeting with him and his team, go schedule and see what they can do for you. But Josh, I'll let you get back to any questions that might come in and let you wrap it up. But I just want to say thanks.
Thanks for the kind words. Sure appreciate it, Chris. It's great to be here with everybody. And yeah, I don't see any other open questions or anything else in the chat. So I'll just end by saying thank you all for being here. It's great to be with this amazing community. And if there's anything we can do to help you in your journey, we'd love to do so. Let's see. I think I might have saw a chat come in here. Okay. We can schedule a time at the link above. Yes, exactly. If you click on that link, you will end up on this page. And on this page, you'll see two things. You'll see the inflation calculator, which is our gift to you. And then below that is a schedule your strategy call. You just pick on the date you want, click on that, and it'll show you all the open slots. Great question. All right, I think that's all the questions we have. So I'll sign off for tonight. It was great to be here with the Tax Hive community. Hope you all have a great evening ahead. Thank you.